the premise of the IUL challenge is like, show me a policy that's 10 years old. I want the original illustration, the in-force illustration. And I just want, given that the product is sold with upside potential and downside protection, show me a policy that's even done what it said it was going to do initially.
Yeah.
It hasn't been able to do it. Chris Noggle offered to match. We got $10,000 on the line. Nobody's willing to even show me one.
You don't know of any IUL contracts that have performed as they were supposed to for income. I know thousands I can show you.
When does IUL outperform whole life in the cash value?
By the time the contract
We're finally getting heated for you,
by
Caleb.
the time the contract goes into where there's going to be loans, we've controlled those costs.
But so would you agree
Which
that
I can't do in a whole life contract. A whole life company can do the same thing. If we're in an environment where that's a risk, there is 100%. The whole life company doesn't have to pay the dividend.
But that's not what I'm talking about. That's not the risk.
You said that.
No, I'm not. The difference with whole life is very flat and it's very measurable. With IUL, if a 0% year adds 5%
fixed
charges.
account is not a 0%.
Yeah, but you're not going fixed. You don't get to choose fixed after the year market does 0 for the year. You don't get to swap it post-active. Would you agree then that your level of management and the complexity of your management goes infinitely through the roof?
It's not that complex.
When it gets to
retirement. It's not that complex. Actually, it's one phone call and 5 minutes to set it, and it's done. That's far less risky. If $1 million loan is out, it's a very small amount at risk where that cost is coming out. Where whole life, it's a much higher cost.
Yeah, but that's not fair because no, it's absolutely not. Mortality is mortality, and if there's a mortality cost for the policy, hold on, no. Let me finish my thought. That's the risk.
But that cost is whatever that cost is for that company.
Right, based on the annual renewable term schedule of their age.
Right, and it's the same for whole life.
No.
Sure it is.
No.
It has to be, or the insurance company's going to business. If the insurance company didn't price the whole life contract accordingly,
they do, but they charge more up front. That is the point. When did it become okay to speculate with life insurance?
I would agree. A lot of the IUL contracts are going to blow up because of the way the agent designed it.
In a vacuum, I get IUL can work. But if the plane's going to crash 95% of the time, do I want to get on that plane?
Which is very problematic. Like, if we can
huge
all agree on this.
We all agree on that.
If contracts blow up, that hurts everybody, because then people say permanent life insurance, but it doesn't sound too permanent if 95% of the contracts are blowing up.
It hurts all of us.
We've sold a couple IULs and we're selling some IULs now, but they're not. I know. Caleb's like, what?
We're just going to get right into it. Terry, we've been friends for a while. You have a background with money tracks. I am very grateful for how you think and view the world. And so you can speak to that slightly if you'd like, but I know the 3 things that you shared were rising costs, not guaranteed, and cap rates. Those are like 3 examples of why people wouldn't want to do IUL, but you had your spin on that. And so you can give a little bit of your backstory, but then what I want to be able to do is break down each one of those points. And then before you jump in, I just want to introduce my good friend, Chris Kirkpatrick. I don't necessarily know you if you need an introduction to the YouTube world. A lot of people know you as the guy that bashes,
hammers on IUL,
sure. doesn't back down. If you're going to pick a fight, make sure you come with the machine gun. So all that to say, it's good to have you here. And let the conversation begin. So Terry, why don't you give a quick backstory, but then let's really dive into the conversation. IUL versus whole life. It's a very hot topic, and I'm hoping that our time together can create light, clarity, and we'll see. There might even be some knockout punches. We'll see.
Gotcha. Thank you, Caleb. So my story begins, I guess, 20 years ago, roughly. Working with money tracks and learning about life insurance. And we used to have a saying that UL meant you lose and VUL meant very likely you will lose. And I could be on stage helping Chris debate IUL, because if any agent wanted to sell IUL, I would pretty much bash you. And I'm a whole life only guy. Believe in whole life, still do. Own it on my family, myself. And it is, to me, the best asset anybody could have. So fast forward, a mutual company that we work with kind of imploded, and that was our primary carrier. And for about a year, I didn't sell any insurance. I was ready to leave the business because that was a major violation of trust for me, made me rethink everything. And when I came out of the trauma of that, I came up and said, this can never happen again. So I looked under the hood very deeply, flew up to corporate offices, met with the executive teams of these insurance companies, because to me, it's not just the numbers, it's the culture and the vision of where this company wants to go to tell you if they're going to be here in 100 years. And what I realized was there is no perfect thing. Any company could go through this. So we settled on the one of the big four as a mutual whole life company to use. And as I was traveling the country, a couple of guys recommended IUL. So you should really look at it. I remember in the days when I used to travel with Don, there were a couple of guys that I believe were really strategic that tried to convince me of IUL, and they didn't sell it the main way. And I remember those conversations. So here's the problem. IUL sold because of return and performance. And life insurance is a putter. It's not a driver. I don't look at it as a performance vehicle. It has to protect the money and do what it's supposed to do. So that's why when you think about IUL has an increasing cost of insurance, that is technically true. So does whole life. It's just baked into the cake, something I've learned. Number two is it cannot be guaranteed paid up, right? These were the arguments. Why would you ever put a client's legacy online where it could explode later on in life because of that increasing cost of insurance? It's not guaranteed, right? And then number three, just a pure, I would say, dishonesty and immoral behavior of the many, not all, of the IUL carriers, the promoters, the IMOs, and everyone's regurgitating the same crap, which is what I was really good at fighting against, which Chris is great at fighting against. But I finally went up to one last meeting up in Virginia, met a guy I've known for 20 years, trust the guy, friends with the guy. And I said, okay, this is the last shot. Why should I use IUL? And he cut through all the crap. He didn't talk about how, it'll blow away whole life. He knew my conviction of whole life. He knew he wasn't good. He knew I didn't care about performance. As a side note, we run all of our IUL illustrations at 5%. We don't even use what we're allowed.
Wow.
And when we sold whole life, we did the same thing. We don't always want, you don't have to oversell life insurance, right? It's an incredible asset without the performance. Okay, performance is important, but that's not why people should buy it.
And when you say performance, you're saying the cash growth.
Yeah.
Yes.
Yeah.
Okay.
Obviously, it's a parking place for your money, right?
Right.
Life insurance is a place to park your money. You don't really make any money in your garage. You take your car out of the garage and go do deals. Life insurance protects your money so you can use it, right? So you don't want it at risk. So what this gentleman mentioned, I don't know if I can say the name, so I'm just kind of keeping things. Your podcast, I'm just here as a servant, is he knew the issues for me was cost of insurance. And what he explained to me was really interesting. We'll start with this one, is that every insurance carrier sells their risk as one pool. Term, IUL, whole life, it's all the same. It all gets sold at the end of the year to reinsurance, where they price it accordingly each year based on mortality, right? So the one thing that I understood, this is how whole life works, is that, and for those that don't know, all life insurance contracts have levers in them, right? And one lever is the cap rate with IUL. With whole life, it's the dividend. It's also cost of insurance, and there's other things because there's more cost than just mortality cost, but we'll keep it simple here. If I say mortality, I'm talking all the costs. So they can move the lever. Well, there's a maximum and a minimum cost of insurance contractually an insurance company can charge. Whole life, every mutual whole life company out there charges the client, when they pay their premium, the maximum cost of insurance comes out of that premium, right? They know that's not going to be the real cost. At the end of the year, when they price and they sell that risk, the delta between what they charged the client, what the actual cost was, they give that back. That's what the dividend's based on to the client. So cost of insurance is mortality. The cost is baked into the whole life contract throughout the life of the contract. If in the later years, the costs go up because an insurance company's underwriting team is letting in too much risk and they're paying out more claims than they expected, then what's going to happen is that maximum cost is already built in. They're just going to lower that delta that the dividend comes back. So really, you can have an increase in cost of insurance in a whole life contract as well. It's just they bake that into the cake. Now switch to IUL, I believe for years, it is term, right? With the cash value component.
Annual renewable term.
Annual renewable term. Well, true, and I argued that. But in reality, we can control the cost in IUL, which we can't do in whole life. And this is where I'm scared for a lot of the IUL out there because agents don't know this, and I believe it's going to hurt a lot of clients. So we use it very selectively, but I can control that cost. So as long as I know I can control that cost, I can set it to where it's actually better than whole life because when the client pays the premium in the early years, only the cost is coming out of that premium. So 100% of the rest of that premium for overfunding it is going into the crediting strategy and getting crediting from day one. And if you do an opportunity cost, which I've done, 5% whole life, 5% IUL, 4%. IUL is going to outperform the whole life just because of that lost opportunity cost of the insurance company holding that money each year and then releasing it. And you can see that in the illustration. So that was a big eye opener for me. And the final thing that got that I, we talk about corridors. I didn't even know what the heck a corridor. I knew what corridor was, but I didn't really understand it until 2 years ago. And when I realized that we can do the point two is reduced paid up. We'll get to that later. It's similar, but we can close that corridor down. And if the insurance company pushes the cost of insurance lever all the way to the maximum, and we pull the cash crediting to the guaranteed, not the index strategy, what the guaranteed on an IUL contract, it does have a guaranteed option to put the cash into. The agent has to do that. So that's the fear if that doesn't happen. Actually, will never, ever, the cost will never exceed what it can earn if it's designed properly. You can't legally, regulatorily say it's guaranteed paid up. I'm not going to say that because I'm a licensed person. But we'll just say it's the same thing, right? It can never go upside down based on the contract provision. So that was enough for me to say, that's what opened my mind to even consider representing IUL, because I don't need IUL in my practice. Whole life works really, really well. The only reason we even started selling it is because it really helps a certain group of clients, not all of our clients, and it works really, really well. It works better than whole life. But that was one of those three things that I had to overcome to even consider using it, is understanding how those costs work.
Before I bring Chris on, last question I have. You when you shared, you said that there's 3 different examples, and IUL was you used for 2 of those examples, but you still use whole life for 1 of those examples in your business. Can you just break down that fast, and then we'll bring up Chris?
Yeah, so basically we've been very blessed. We didn't go after this market, but after 9 years, we've grown into 2 very high-end markets, business owners that are earning significant revenue, $500,000, $2 million a year, and surgeons and doctors that earn that kind of revenue. And so using an insurance contract as a, quote, Roth alternative, which we would use whole life, short pay, paid up 65 contracts to generate income, that's really where the IO has replaced, right? And the problem with that contract, and this is a contradiction in our industry, I believe that as a family, you should have the most amount of death benefit you can afford, right? But if you're designing a contract for income, it's the opposite of that. Yeah. So it's not one versus the other, it's both. But if we're going to use the contract as an income play, right, not as a legacy or covering a pension play, which we do that too. If we're using it as an income play, we want the best possible outcome. In designing IUL versus trying to design a whole life, the IUL blows away the whole life.
When it comes to income.
When it comes to income.
And you're using loan assumptions for that.
And that, yes. And,
okay.
and that's another key when we go to the third point of carriers, because there's really bad carriers and really good ones that make sure the client's protected. But that's really the only vein we're using IUL. Every other vein we're using highly funded whole life like we always have. Believe in that product.
Chris, you didn't talk for 10 plus minutes. That's impressive. Why don't you give a little bit of your backstory? Most people know who you are, but I think it's helpful. And then why don't we address the first point that Terry made as it relates to rising costs?
Yeah. So, my background, I used to be the director of business development for one of the top IUL companies in the country. I sold IUL for a long time. We actually had dinner last night and talked about our story a little bit. And, after 4.5 years of doing it, I'm the opposite. I thought it was this amazing tool, and I was doing it all the right way, max funding, all the things. Come to realize that, it just wasn't in alignment with my values and beliefs, with what I was envisioning that I would, it wasn't solving the problems that I thought it was solving for people. And so for me, I just needed to make a big pivot. And quite frankly, when I made the shift from IUL, it's so funny how similar it is, because when I made the shift, I didn't even really know much about whole life. I'd gone to Cal College, I'd gone to, all the stuff and done the mentorship program and all these different things. And still, I was down there going to Don being like, hey man, why don't you get this IUL thing? And he's like, buddy, son, come on now. Doing his Don thing, and it was because of the conversations with him that I decided to like really question things and take a step back and dive deeper into the whole life insurance. And I'm like, I thought this is what I was selling the whole time, you know? And so, you know, then I made the shift. I went down this path, and I guess, so what's the first thing you want me to cover here?
What Terry talked about when it comes to rising costs.
Yeah. I mean, rising costs, like the way I look at it is, the challenge is we look at life insurance, whether you're talking IUL or whole life, we're talking about our entire life, right? Like that's what we're after. It's like, I don't care what the policy does right now. I don't care what it does 10 years from now or 20 years from now. I care about like, what's it going to perform as throughout my entire life. And so one of the things I love about whole life insurance that I talk about all the time is the fact that it grows with you in every phase of life. It'll solve different problems for you at different stages of life. It's dependable. It's predictable. It's the financial stability and security that you can lean on, you know? And so when it comes to IUL, the biggest fear that I have with IUL is that or at least the reason most people are buying it is for tax-free income. The way it's sold, that, you know, people say that it outperforms whole life, is in the tax-free income in retirement. The challenge is that when you get to that point in time, I mean, I've run models and looked over thousands of illustrations with pretty much every carrier that I've heard of, you know what I mean? And when you really break it down and you lean on tax-free income every single year, it almost always breaks down, you know? And so I use the analogy a lot. It's like, I don't say IUL can't work. And I want to make that really clear. I mean, I've done this IUL challenge where I've asked people to just show me one illustration that can work, right?
And your definition of work is matching the
just match, just like for the policy to do anywhere close to what it says it's going to do, you know? So the premise of the IUL challenge is like, show me a policy that's 10 years old. I want the original illustration, the in-force illustration. And I just want, you know, given that the product is sold with upside potential and downside protection, show me a policy that's even done what it said it was going to do initially.
Yeah.
It hasn't been able to do it. And I've literally had hundreds of thousands of views of this stuff. I'm offering now. Chris Noggle offered to match. We got $10,000 on the line. Nobody's willing to even show me one. You know what I mean? That to me. So the biggest thing that I say is like when I look at this and I go, all right, if I'm looking long term, philosophically and fundamentally and just like emotionally and morally for me, I look at it through the lens of like, I don't want to ever have to say I'm sorry to anybody, right? And I look at it through the lens of how can we speculate? And I said this in my talk yesterday. When did it become okay to speculate with life insurance, right? Because when we look at it from a long-term perspective, there's not one person alive who has fully funded a policy and used it successfully for income. All the ways that people are saying that it's the way that beats whole life. It hasn't been proven. It hasn't been proven. Go for it.
So there's three things that you said that I want to kind of comment on. So the one thing is, as far as the challenge to find an illustration that a policy that's performed to the illustration. Between us here, I don't think that's fair because you can't find a whole life contract that's performed according to the illustration. The reason for that is because underneath these contracts is a general account.
Sure.
And the general account is a bond portfolio. And with a mutual company, the policyholders share the profitability of the company. And as interest rates have come significantly down since the financial crisis in 2008, every one of these companies had a deal with smaller amounts to buy options with an IUL or be able to pay the dividend and offset those costs of insurance. So that, I don't think that's fair, but I'll give that to you, but I don't think it's a fair assessment.
Well, can I just respond to that real quick?
Sure.
And then so I would argue that it's not an apples to apples conversation. Like you're not using whole life insurance as an investment alternative the way that people are utilizing IUL.
Okay, would you agree that whole life insurance can be used as a tax-free alternative for income for certain clients?
I don't think it should be a strategy. This is just me. I don't think it should be a financial vehicle that's utilized as an annual use of income. As a volatility buffer, sure. As a strategic asset to use in down years to make your other assets perform better, Sure.
Okay.
But not on an annual basis.
Not a straight income stream.
Correct.
Which you agree. How about a bucket approach for volatility and for tax brackets, depending on varying the income to fill up certain tax brackets?
Yeah, sure.
Okay. So in those two scenarios, again, IUL, and so the other thing you said is you don't know of any IUL contracts that have performed as they were supposed to for income. I know thousands I can show you that work really well in that arena. I think it's dangerous, and the whole life companies and the IUL companies show using life insurance as an income stream for 20 years. And that's something I think in our industry we need to stop, because it's a really dangerous thing that they show. So I would agree with you on that 100%. And dragging down an IUL could have some more risk than a whole life in that scenario if it's not designed properly, which most agents don't design it properly. If it's designed properly, in my opinion, will outperform the whole life contract. But
I'm just going to jump in here before. When you say you have thousands of examples, are those illustrations or are those actual in-force?
Those are actual clients that have been drawn down.
Income.
Yeah, and that's part of the organization we're with now, because that's what had to convince me. And I mean, I've seen those, and I mean, I can send those to you.
And
I've talked to those clients that are.
If they want 10 grand, they can submit some. We can.
Well, the contract. The challenge is, did the contract perform according to the original illustration? So that I don't.
Yeah,
but as far as you said, you don't know of one that where they're actually using it as it was.
Sure, you're right. But here's the deal: you don't have to illustrate it with the max rates that the companies say. So that just goes to show the people that are selling them, if they sold, it's not a matter of how much money's in the policy, it's a matter of what are the expectations. Now, and to your defense, I'll beat you to the punch. This happens with whole life too. A lot of people, if you sold whole life in the 90s or 80s and the dividend rate was 12% or 11 or 9 or 10 or whatever it was, and you bought that, if you look at the current assumptions in a whole life policy, now you're looking at all right, it's a dividend's going to be paid every year, and the assumption is it's going to be the current rate. And so dividends go down, policy performance is worse. This is where whole life gets a horrible name. Right. It's because people are sold something, they don't understand what they're buying. And so you're dealing with that with IUL now. Like, it's like the challenge. Nobody had to run the illustrations at the absurd 9% assumed levels. But they do. Okay.
Yeah, this is where we agree.
But if we had one person that would just do it right, if they wanted 10 grand, they could submit it. Yeah. And I didn't create the IUL challenge not to say that it can't work. In a vacuum, I get IUL can work. But if the plane's going to crash 95% of the time, do I want to get on that plane? Or if there's a 95% chance I'm going to crash, there's just too many variables. But you're saying
95%. What do you reference to the 95% crash?
I'm just saying.
Are you saying 95% of IUL is actually going to lapse?
Like 90. Yeah, exactly.
I don't even know if I agree with that. 95%
by the end of life, if they're going to use it for income, absolutely.
Yeah. And you can see if that's the belief, why that is IUL is evil. If that's the case.
So I want to say that I don't know who the audience is here, but I want to say something that's really, really important. Okay, number one. Back in the day when we used to train agents, and we talked about the benefits of whole life or permanent life insurance. Right?
Yeah, sure.
There's 3 primary benefits. Number one, it's the only product that's going to guarantee to do what it's supposed to do. That death benefit will be paid no matter what. Term insurance can't do that.
Sure.
Number 2, you can have access to the money along the way. Okay. Number 3, it's going to give you a rate of return. And something we used to say, don't expect that rate of return to compete with the stock market. It's not what it's supposed to do. Right. But over history, it generally does better than other accounts that guarantee money like your bank or your CD.
Sure.
Right? And we used to try to implore the agents to never try to sell the dividend or the IUL, just because if I put a newspaper ad out today and said, I've got a product you can put your money into that guarantees, death benefit, you can access, and it has tax benefits, right? And it's gonna be right, even if it's a point under a money market. People are gonna line up around the corner to put their money into that thing.
I agree.
We don't have to boost the illustration, which 95% of the agents do that. I actually agree with Chris. A lot. He's probably right. I don't know the stat, but I would agree a lot of the IUL contracts are gonna blow up because of the way the agent designed it.
Which is very problematic. Like, if we can all agree on this.
We all agree on that.
If contracts blow up, that hurts everybody because then people say permanent life insurance, but it doesn't sound too permanent if 95% of the contracts are blowing up.
It hurts all of us in this room. We all are part of this industry, right? That's why every IUL contract we run at 5%. We don't even run at the 6.5 or 7 you can run.
You were going to bring up 2 other points. I don't know if you remember that. Did you have a comeback to, or?
No, go ahead.
Okay. What was the other 2 points you were going to give on the first?
So the second point is the fact that you can't guarantee pay up an IUL contract, right? So I'm on camera, so legally you can't, but effectively you can do the same thing. And this is where, again, some of the high-end IUL people that tried to convince me don't know what I'm about to share with you. Very few. The guy who shared this with me is one of the architects of the product, really high up guy that knows the product. So most of the people selling it don't know it. The wholesalers don't know it. The IMOs don't know. The IMOs, most of them don't know much, right? They're just selling the product of the month.
That's the truth.
Which is scary because that's the problem. So, but what he shared with me is says, listen, here's how it really works, and kind of picked apart how life insurance companies' general account works, how risk works, how mortality works. Mm-hmm. Mortality is the same. So so guaranteeing paid up also has to do with the first point, because if increasing cost of insurance goes way, way up, then it's going to blow up, right? It's not going to work because the cost out. Right. So the two are married, right? But in reality, if you have what we call an investment grade company in the whole life space, which are probably the 5 you work with, there's certain rules they have to pass, right? Part of that is underwriting has to be really strict. Mm-hmm. Because if underwriting is letting in a lot of risk and it's easy, that company is either going to close and sell themselves, or costs are going to go way, way up in the future, right? So we have over 100 years of history, which is, there's only 1 or 2 IUL companies I'll even consider working with. The rest of them, I don't trust them as far as I can throw them. We've got over 100 years of underwriting and mortality, okay? I feel pretty, and they're a whole life company as well, they're a mutual company as well. So I'm not concerned about cost of insurance going up in these contracts. As long as I know the company doesn't violate the rules of being an insurance carrier and having a strict line on the risk they want to take in, mortality is mortality. In fact, mortality has gone down, and I believe will continue to go down, because the 3 biggest killers in our society, heart disease, diabetes, and cancer, are no longer killers. My dad's 80, no rocks has lived past 70 because of heart issues, right? So modern science is extending life expectancy, which means costs have actually gone down from what the actuaries were expecting, which is a benefit. But back to the point, I can design a contract that is reduced paid up with whole life, right? Mm-hmm. The delta between the cash value and the death benefit is what it is. It's what I've learned over the years. That's reduced paid up. Reduced paid up to me is the lowest death benefit for the maximum cash to not break the MEC line, right? Otherwise, can we just bring the death benefit down to the cash value? That'd be awesome, right?
Yeah, and I'm just gonna, so just for the listeners, because there's people that sell life insurance, but there's also a lot of people that don't sell life insurance.
Sorry.
So yeah. Our RPU is when you stop paying premiums and you can pay up your policy, and in whole life, there's a world where you can stop paying premiums and the contract will continue to not implode, cash value will grow, death benefit will grow. But when you do that, the death benefit drops. And you're saying that, for example, like let's say you have $100,000 worth of cash value, and if you RPU, you could have $300,000 worth of death benefit. Yeah. And then every year. And so just from a context.
Yeah. So in essence, you have permanent death benefit for the rest of your life. You don't have to put any money in the contract. Right. There's enough money that it pays for itself forever, right? Yes. But if cost of insurance goes up, there might be a point where the insurance company says, you got to put more money in this thing, right, or it's going to go away, which happened with UL, and it happened in the 80s when it came out because agents were overselling the performance and minimally funding it, right? That happened, right? Mm-hmm. So if it's designed properly, then you have enough cash in the contract. And one thing about IUL, for people that don't know what IUL is, it's indexed to something like the S&P. It has a cap and a floor, which means if the S&P 500 in a year cycle goes negative, it's a floor of 0. You can't lose any money. You don't make any money that year. The cap is, say, 10%. If the S&P does 8, you get 8. If it does 12, you get 10. It caps out at 10. So over 10 or 20 years, you get the average of that, and it averages out, which we've actually tracked the real average using real historical cap rates, which the carriers don't put in their illustrations. We've done a lot of homework. We know the science behind the scenes. So I feel really confident about our numbers because we've looked back 100 years actually and tracked this. But back to the point, when you reduce a contract, the insurance company has a net amount at risk. That cost of insurance is coming out of the performance on the cash, right? In a whole life company, it's when a whole life company says they're going to give you 6% dividend, you're not going to see 6% on your cash. You're going to see something like 5 or 5.5. Mm-hmm. The difference is the cost of insurance for that death benefit, right? So when I started exploring IUL, I kept seeing these reduced contracts, and the delta was like 20% of what it was for whole life. And I'm thinking, this has to be a MEC contract. And then the guy's like, no, it's not a MEC. How can that not be a MEC? And I couldn't sell the product until I understood it. I actually flew up to 2 home offices and neither one could explain it. And I got on the phone with somebody I know and he finally explained it. And he said, listen, Terry, when a whole life company does a reduced paid up and says that's the minimum, that doesn't mean the IRS won't allow them to bring it down further. I said, okay, well, why wouldn't they do it? I goes, why do you think? Like, I don't know. And he says, well, how does an insurance company make money? Selling risk. That's how they make their profits.
Sure.
So he goes, could it be, and I'm not saying they do this. I love whole life. I mean, I own mutual whole life and companies got to make money and I want them to be sustainable, right? If they're not making money, they go out of business. None of this works. But could it be that they're not allowing it to come down because then they have more profitability? Interesting. Where IUL, it comes down to where it's such a small amount at risk. If you take the lever for cost of insurance and you push it all the way to the maximum allowable, which we'd have to have like a mass extinction event for that to happen. My understanding is half the population would have to be wiped out. If COVID killed 50%, then they would do that. That's kind of an old thing I learned a long time ago. So, but let's say they push that up there. Index universal life insurance, every year we can reallocate the cash. It doesn't have to be in that index strategy. Mm-hmm. So if we believe, and I've tracked it back 100 years, I'd probably leave it in the index strategy. Let's say the world falls and we believe that the S&P is just going to keep being negative. We can move the cash to the guaranteed account. The guaranteed account is pretty close to what whole life guarantee is. And it's like 4% right now, which a lot of the whole life contracts are 4%. Some of them actually went down to 2%. In the last few years. But if you look at the cash in the contract at the guaranteed crediting next to the maximum cost of insurance, it's never going to flip. It's impossible. So I can't say it's guaranteed, but it will never go upside down.
So what you're talking about is just reducing the corridor and just shrinking the amount. As you get older, the corridor can shrink.
Right.
And so what you're saying is every year you're going to meet with your clients. And at 65 or whatever age they stop funding the premium, you're going to shrink the corridor to the maximum level. As they get older, that corridor is allowed to shrink legally. And so you're going to manage that corridor to reduce their cost to the maximum capacity. Is that what I heard?
In essence, but I would never do an IUL contract where I had to have that meeting at 65. We would be using whole life. We're using IUL to fund it over a 5 or 10 year period. And we're managing it for that 10-year period, and then it's done. And we've got it designed from that point on where it's self-sustainable. So yeah, for 20-year funding, meet them at 65, make sure that's done. We wouldn't use IUL in those cases because of that risk.
Self-sustainable.
We've closed the corridor down.
But like the corridor gets smaller as they get older. So if you're not actively managing that corridor every single year as they get older, you're not eliminating the risk. Because the corridor is larger the younger they are. The older they get, the smaller that corridor is allowed to become. And so an 85-year-old can have, if there's $1 million in cash value, it could be, I think it's like a 5% corridor. So there could actually be only, say, $50,000 in addition on insurance. So you could have $1,000 or $1 million of cash value and then $1,050,000 death benefit, right? And so that corridor is smaller. But when somebody's 50 or 60, that number's bigger.
Correct.
So every single year that corridor is allowed to shrink. So if you are not actively managing that every single year, it's not efficient.
Well, it depends on so this is a much deeper conversation, probably not appropriate for a podcast, but we do design the contract so that it gets so we have a funding period where you have to keep that corridor open per se,
Sure.
so that the person can fund it. Again, these are highly sophisticated clients. This is not mom and pop or your small business owner. We would never use IUL. As someone said yesterday, it's a Ferrari versus an F-150. Whole life is an F-150. You can rely on it, set it and forget it. You're never getting in trouble. IUL needs a lot of finesse and maintenance. So for the type of client we're using it with, they have a huge amount of cash. We have a client right now, it's got $1 million, put $100,000 a year into an IUL for 10 years and they're done. Those are the types of cases we use IUL for. That's it. We're not using it for other cases.
But you believe that IUL is better than just investing in the markets?
Well, that's a different conversation.
No, I'm just.
Yeah,
but it's
I
like,
don't think I even heard him say that. Although I did hear you say it's a Roth alternative.
So I will say this. So every one of my clients that are AUM clients, because we do manage AUM, if they don't ask me, I make sure and tell them that I don't have a penny in the market.
right.
All my personal wealth is in life insurance. So if you have a problem with that, we might not be your firm, but if you want to be in the market, we're going to do the best we can. But we teach them what the real returns in the market are. I'll go on camera saying, I believe life insurance will outperform the market if you measure it correctly. Most CFPs don't know how to measure it correctly, right? If you measure it correctly, I believe life insurance will outperform the market. I believe whole life insurance will outperform the market when it's designed properly. And for those cases that a Ferrari is appropriate and that extra maintenance is appropriate, I believe IUL will outperform whole life. So yes, I do believe.
That makes sense. That makes sense to why you believe what you believe.
Yeah.
So your life insurance above market.
Now you might get a lot of comments on saying this guy's out office rocker. How the hell can whole life insurance outperform the market? I'll be glad to show you the math.
Yeah. We'll have
And the
part
real
two.
numbers.
That'll be fun.
That's part two.
I mean, so what I'm hearing though, like from you, and we talked about this a little bit last night, but and you mentioned it in your talk yesterday, is that you'd be worried about your clients, like you are the key to your client success.
Yes.
Right. And so one of the biggest problems that I have with IUL is that they're way more risky than they're let on to be, that you can lose money in them. Right. And the active management of them, if they're going to work, is absolutely essential. And you are the key to your client's success in that IUL. Right.
Yeah, so probably one difference is I'm not a life insurance agent. We are a comprehensive planning firm.
Yeah.
So we're not selling a policy and then never seeing the client again, which a lot of the IUL agents do.
Sure.
We're meeting our clients quarterly. We're managing their investment portfolio. We're managing IUL like a bond alternative. It's actually easier to manage the IUL. To your point, it's easier than the equity side. But most agents that sell it don't do that, and that's a risk. So we're a little bit different in that approach. But yes, you're right. I have to manage it. I have to manage it regularly, just like I have to manage a portfolio. So that's part of our succession plan in our practice. If something happens to me, we've laid all this out of how these things need to be managed.
So don't you think that's pretty scary that you have this product that needs to be actively managed like equities, but is regulated like a regular fixed product?
That's a good question.
I do. I think the industry needs to bring more regulation to the product. I do.
I think it's pretty scary.
We're licensed, but a lot of people selling it are not licensed for that.
Sure. Yeah.
I would agree.
I guess for me, like
it's actually an interesting question. What if, and I'm not a pro regulation for the record.
Neither am I.
But like, what if IULs, you just had to have more licenses like you would have to actually invest? Because big thing is whole life insurance when set up and used properly. Yeah. We're not selling it as an investment. People are attracted to our message not because it's an investment. I feel like the pitch for IUL is like, this is the best thing since sliced bread, but you have people that aren't going to be around for a while. They don't have experience. They're working with bad companies. They're not structuring it, and then they're going to be gone. And so all those things are you're setting. And if it's like if it's anywhere close to 95%, even if it's 50%, that's a train wreck.
Right,
it's
exactly.
a train wreck.
And it's over 50 for sure.
But going back to like, that's an interesting thought that you have.
Yeah, and let me make sure some of my friends in the industry are like, what are you talking about more regulation? Like I'm not for more regulation either. I don't believe you can regulate morality. Like, on the investment side, I'm a fiduciary. You won't see that on my website. Clients ask, well, why is it on your website? Because I don't believe you can regulate morality. I know commission brokers that earn commissions that take far better care of their clients than a fee-based. But when it comes to something like IUL, okay, it breaks my heart. Even whole life in general, whole life insurance has a bad reputation for a reason.
Yeah.
A lot of the people selling it are just selling a product and they don't understand it. And that hurts all of us that are doing it the right way.
Totally.
And IUL, to Chris's point, if it was done the right way, it probably wouldn't have such a bad reputation. And I don't know how else to fix that, but I think the carriers are very responsible because a lot of the carriers just don't care and they just bring in the money and they don't really care about the consequences. And that, I think, somehow that has to stop. Maybe it's us changing it, but I do agree. I think that you need to have a 65 license or something to sell IUL because these agents that are selling it as an investment have no, I'm sorry, I'll just say they have no freaking idea what they're talking about. So
I agree. I mean, I think IUL would go down the VUL path, right? Where, I mean, my team looks at VULs all the time, and one of the things that we see is like, there's a lot of really poorly structured VULs and there's some that are decent, and so, but what I know is there's a lot less volume of VULs because the barrier to entry to get into it and sell them and whatever. And the people that are actually selling them, they're part of a more comprehensive plan because they're licensed to do other things. They have different philosophies. They're trying to solve different problems, right? And so to me, that's what it comes down to.
Yeah, and talk about belief system. I mean, I really had a thing against VUL because I saw a lot of bad stuff. But I've met some guys that, and we don't use it, but I've met some guys that sell it and they do it the right way. And that opened my eyes. Wow, it can be done the right way. But that's far and few between.
I actually want to ask you a question. And this is something when I think about it from my values and beliefs, one of the reasons that I am whole life all the way and why I am so rage against the machine for IUL. Okay. So when I look at whole life and I think about, all right, what am I doing? When I put money into a whole life insurance policy, I'm preaching to the choir on this because I know you know this and feel this way, but you're partnering with a life insurance company, right? Like as long as that company is financially stable, which there's no more financially stable company in the world than these participating mutual companies, historically compared to other alternatives. And when I put my money there, as long as I pay my premium and that company's in business, I'm solid, right? I'm effectively a shareholder, a business partner with that company. And as long as they're there, I'm going to be solid. Now, it may perform a little worse. It may be better depending on what dividends do, profitability, mortality costs, all these things. But at the end of the day, I know that I'm basically saying, all right, insurance company, what you do best is get me the best rate of return possible with the least amount of risk possible. We agree?
We do, 100%.
Okay. So that's why I give the money to the whole life insurance company. Not because I want sexy returns, not because I want to beat the market, because I want a safe place for liquid accessible capital, for emergency, for opportunity, for my legacy, for all these things, right? When I take money and I say, all right, let's have a conversation about IUL. As soon as I put money into an IUL policy, I'm no longer a partner with the company. I'm, by definition, a profit center of the company. That is just the way it is. Fundamentally, we can argue semantics about the moving parts in the policy and the corridors and the charges and all the fees, but fundamentally and principally speaking, if I could pay my premium and the company could still be successful and my policy could still technically fail. So fundamentally and principally beliefs and from a values perspective for me, I look at that and I'm like, I want no part in that. Like and it really bothers me to see all these IUL agents out there right now. And I'm sure this bothers you too. So I'm not saying this because I don't think you do this, but I'm just sharing kind of what I see and why I am so rage against the machine is that so many people are like, oh, do what Ray Kroc did, do what, JCPenney did, do what Walt Disney did. And then they sell people IUL when IUL didn't even exist when they were around. Do what the Rockefellers would do. Garrett Gunderson just talked about, he rewrote the damn book because people were using it to sell IUL. Right? Like, and so it really just comes down to, they're saying that, all these IUL agents are using the fact that these companies have been around for 180 years. It doesn't matter with an IUL. A company can still be profitable, successful, prolific, and whatever, and your IUL can still fail. And so what do you have to say to that?
I disagree with part of what you said.
Okay.
And so there's IUL carriers out there that are for-profit stock companies. And there are mutual companies that also have IUL.
But you're not, but still with the mutual companies, I work for one.
But a mutual company, right? If they're a mutual company, all of the costs, all of the expenses from the CEO's salary down is public record.
Mm-hmm.
The profits as a company are shared with the shareholders, which are the policy holders. So here's what got me over because I had the same hurdles you did. When I got down with this one specific carrier, I'm not going to, I don't really want to mention the name, but it's really the only carrier.
I have a feeling I know who you're talking about.
We write business with, right? And they are a mutual company. They have multiple insurance companies, but I got to know at the home office the chief actuary, the chief product designers, and I saw how they design their IUL. And in fact, their IUL is not competitive. In fact, they lose a lot of sales. Mm-hmm. In fact, when AG 49 came out, they didn't have to change anything because they weren't boosting their illustrations. They don't have closed books of business. So they're doing everything right to benefit the policyholder. They're not trying to benefit the machine.
It's a cleaner, simpler version of most IULs.
Right.
Less moving parts.
I guess, and after going through the mutual company that blew up on me, I don't trust any company, but I trust this company with how they've designed the product enough to represent it. Okay. Because look, my reputation, it was very painful to go through this demutualization a few years ago. Mm-hmm. I wanted to leave the business. I had to look my clients in the eye. So I don't need to sell IUL. We have a very successful business. Every one of the clients that we serve, we can use whole life for.
Sure.
I don't need IUL, right? So so why am I doing this? Because I truly believe in the research I've done. I'm a math geek. So sure. Like I said, I know how many people have actually done real cap rate history back 30 years and then back tested it using the tools we have on the investment side to really see what's going on. I know my numbers and my science. I can show that to anybody. That's what convinced me. And then we actually added buffers. We did worst case. And we even made it more worst case than reality and said, okay, as long as we do this, we feel confident in the product. So not a lot of people do that. So that's my answer to your question is, I believe the carrier that we've aligned with does consider themselves a mutual partner with their policyholders, and they are a mutual company. And I've seen it in their design. I've seen other companies that's not designed that way, and it is a profit center.
Sure.
And this company's not only given up profits based on 5 less years of premium finance charge, they've also given up boosting illustrations and given up sales. I know agents, I won't write them all. They suck. And I'm trying to say, you're selling a company that has a 12% cap that's probably going to drop it in a few years. This company is giving you an honest rate. And the agent says, well, this is easier to sell, right? So I agree with you, but could it be, Chris, that, and you and your carrier took on a lot of risk back 15 years ago. I said, that carrier is going to be in trouble, and they were. Is it possible you had we all have our issues, right? That, being a little bit open-minded. I understand where you were, but not every carrier is the same. Maybe there's some differences.
Well, no, I just look at it like what I have come to the conclusion for me is and the reason I have the very polarizing beliefs that I have is because of the fact that it's not, I don't want to trust people, because the company that you're with right now, leadership can change.
That's
Vision
true.
can change.
Very true.
Directions can change. So what I know to be true is that the contract, because make no mistake about it, the contract and the languaging in the contract with a whole life policy protects me, the policyholder. The contract, as long as I pay my premiums, I know it's going to be there.
But if you go through a demutualization,
okay.
So
let's
add leadership.
But
and so, are you familiar with Bobby Samuelson?
Of course.
Have you read his stuff on this carrier that went to demutualization?
Yes.
You've seen what they've done with those levers.
Yes.
So this company has a guaranteed dividend rate.
Yeah.
Which is total hogwash because they moved the cost lever up, and that's a mutual company. So leadership could change with any.
That absolutely can happen, and there's whenever we talk about a guarantee in a product, we're talking about that guarantee being guaranteed by the company, and if the mutual company goes haywire, so to speak, or starts making irresponsible decisions, or they manage blocks of business improperly, or whatever, then Sure, things can happen. All I know is that with mutual companies, and here's what I'll say though, also to the company that demutualized, to that company, it's like, all right, it was like you were an advisor, right? Like you were the agent, and Caleb, you were too, weren't you?
Yeah.
Yeah. So you guys both went through this with this company, so you both experienced it. And while it created a lot of headaches and there was some pain or whatever, at the end of the day, nobody lost everything, right?
Correct.
People were able to 1035. People were able, like, in the
And
worst case scenario,
if
you would have stayed with that company,
Yeah.
it wouldn't have been ideal. It wouldn't have had as much upside, but the guarantees would have still been there.
Correct.
Correct?
Yeah, guarantees didn't change.
Okay. So from that perspective, when I put my money in a whole life contract, I'm protected, right? I can't lose everything. It might not be as good. And if something horrible happens like that, I could 1035. I can make different changes. I could do different things. Fundamentally speaking, in an IUL contract, leadership can come in, the levers can change, the market, the economy, the variables. There are all sorts of levers inside of every IUL contract that can be
but there are contractual caps on those levers, and that's what I was talking about. The carrier that I'm working with, they have put these caps on these levers that I've not seen any other IUL do, which is to favor the client, to protect the client, not themselves. So I agree with you on that, but every carrier is different. Culture is important. That's why now I actually fly to the home office once a year of a couple of carriers, because I want to see what they're doing. I want to look under the hood of the numbers, but leadership is really important to me.
Okay.
Right.
But what I'm also hearing from you, and I just want to make this point to anybody who's watching this, like whole life guy versus IUL guy, is he's vetted, and this is a compliment to you, by the way. He's vetted this, and out of all the dozens of companies you've looked at, and most of the major dozens of companies, you've pretty much settled on one company.
One, maybe two, and the second one is half and half with trust.
And even in the one company you found out of the dozens of companies out, actually 70 companies out there, I don't know if you've checked them all out, but like selling IUL, you use one company right now, maybe two, and out of those companies that you have access to, you use it only for a very small percentage of your clients.
Everything else is going to be whole life.
And even in those people that do that, you acknowledge that the key to those policies being successful long-term rides on your shoulders.
Correct. Or the systems we put in place to protect them.
Okay.
Correct.
I think a lot of us agree. I think we agree more than we disagree. My question for you, Terry, is when it comes to early cash value, what performs better? Like we're designing contracts that get 85, 92%.
That's a great question.
Liquidity early on.
Yeah. So again, I can't speak for a lot of the other product designs with IUL because so the biggest company out there that everybody's selling, I can't say their name, but they start with an A. To me, is one of the.
They end with a Z. I don't know.
Which is one of the worst. I would not touch them ever. I can't even look at their design because I can't get past what the company's doing.
Why do you think it's the number one selling IUL in the market right now?
Commission.
Because it's easy to sell.
And commission, maybe the fact that they get a 165-point contract. Do you think that has an impact on?
I didn't even know they did that, but yeah, I would assume they do. Right. So yeah, that's the problem. In fact, the carrier I'm writing with is one of the lowest comp rates. It's horrible. I mean, well, it's not horrible. It's good.
He doesn't mean it.
It's good.
Yeah. But I get what you're saying.
And the renewal sucks. The renewal's a fraction. But guess who's getting the renewal? My clients are getting that money.
Yeah. You're really not fun to debate with because we agree.
I know it sucks, but
I'm not gonna lie.
We were talking about something before I said that.
What were we talking about?
The
cash value. I wanted to
early cash value.
Early cash value.
Early liquidity.
So we actually have a current case that we were testing, and it's interesting because you can put the carrier we use. You can put what's called an early cash value rider on, right? Which when you put an early cash value rider on, you're reducing the options budget. So for your listeners that don't know what that means, is an insurance company when they buy options, those are real instruments on the market, and so they restrict the access to your cash in the early years because if you get your cash out, they have to cash in those options, right? So there's a surrender charge. So you can eliminate that, which is also going to minimize the performance on the contract. Now, this is just made up numbers. This isn't real, so don't test me on that. But maybe it brings the cap down to a 5 instead of a 10. But it gives you full access to the cash. So I believe whole life funded properly was better for early access to cash than the IUL because of that. Because you're not performing as well. When we've run our tests, it's almost a wash.
Hmm.
It's almost a wash. And so it can be designed. This one carrier, I don't know about other IULs, you can pretty much match what whole life is going to do for early cash value. You are reducing the performance, which is going to be similar to what the whole life is going to do.
I had someone recently on my show that said that you could get lots of early cash value in an IUL and take loans at like 3%. And I'm like, I couldn't fact check him on, but I'm like,
I had someone bring that up to me a few months back,
and I was just like, I just don't.
And I don't think it's true.
My BS radar goes off because it's like, how can that sustain the company?
There are some companies that offer like, it's almost like it. I don't want to say a bonus, but it's like an introductory rate. Like for the first portion of the time of the contract, they'll offer lower interest rates.
It's like credit cards.
It's
like a 0% credit card for a year, and then
here's the deal. It's insurance, and we'll agree on this completely. Is that there's no free lunch, right?
Right.
And anytime and that's what I really don't like. And this company that you are using, it sounds like they do things much more cleanly, and there's not a lot of levers and moving parts more than necessary, right? Because by the nature of IUL is there's moving levers, right?
Right.
The problem is a lot of these companies have added more levers than necessary, and different companies have different levers, and so you can't just go through and say these are the levers, because every company. With every new product comes out with different things. Every regulatory update with AG49 in 2015, AG49A in 2020, AG49B in 2023, like it all changes, and the companies constantly roll out new products to add new levers to get around regulatory updates to make it so they're trying to like rein in these illicit illustrative tactics that, whatever. And then these companies have actuaries. I equate it to like the feds chasing Capone back in the day, because Capone could just like maneuver because he didn't have any regulatory crap to jump around to like be caught, but the feds had to operate by the book and do these things, and by the time they got to him where he was, he's like, haha, suckers, I'm over here, like, and whatever, and that's what's happening in the IUL space right now. And so what I know to be true and what I see all the time is whether it's multipliers, low volatility indexes, engineered indexes, these low interest rate loans. If you're getting a low interest rate loan in a thing, I guarantee you it's at a cost somewhere else in the policy.
It is. Yeah. So my third point, which I didn't get to yesterday, was the title was cap rates, but it was really what Chris just mentioned, right? And that's why my argument against whole life, and being a math nerd and an analyst that knows how the numbers work, know that it's all BS, right? And it's just for sales. And so that's why I would argue, and agents would still say, well, I'm getting a bonus, getting this. It's like, no, it's all smoke. It's all smoke and mirrors, right?
We agree on that.
So having to align with a carrier that doesn't play those games, that was going to be my last point, was carrier selection is so important if you're going to do it. It is with whole life too.
I do believe it is a weak argument to say IUL versus whole life if you're only going to say I'm only going to work with 1 to 2 carriers. And
that's why this debate isn't very fun.
But I do appreciate, like, I think it's going to be helpful content, because it's like, listen,
I agree.
I actually think I'm more aligned. Like, I agree with, there's like, sometimes Chris called me the other day.
Like him.
I don't know why. Well, no, but it's like, remember I did a video. I did a video the other day, and I kind of like shared pros and cons of both sides, and like I understand that can tick people off that want me to be like all in. I feel like life insurance is a tool. My big problem is when you look at the amount of people in our space and the companies and the network marketing, and like you start stacking it on, and then it's like malpractice, and these people have a license that you don't need to be a genius to get, and now we're not just, it's like people are going to get hurt big time, and then the regulations that we all don't like, there's going to be regulators hate what we do,
right?
And they're going to ruin it for everybody.
You're exactly right. And that's what's going on in the investment space right now with what we're doing. I mean, these new rules on, it's insane what's going on, and I can't really speak on that space because I don't, but and that's the problem. A few bad apples, which then gives all of us a black eye. Then the regulators come in and they cut and they take away what's really good for the client, not realizing.
I have two more questions. So would you recommend people do like infinite banking with an IUL, or utilize their cash value in the first 5 years in an IUL?
So infinite banking is a different subject. So we believe in the philosophy of infinite banking. It's we teach our clients how to use life insurance as a bank. One of our clients are contractors, big developers, and they use their life insurance as a bonding alternative and a banking alternative. So we very much believe in the concept. And the infinite banking world is a little bit of a taboo-ish. I mean, I have a lot of history. New Nelson Nash, actually, our old company built the first calculators to prove, because the regulators were going to shut down infinite banking, and we helped prove the validity of it. Which the validity of it, the only reason it works, and it's a very fine line, is it because you can access earnings that should be taxable through a loan and not pay the tax, and that's the arbitrage that makes it work. Otherwise, it collapses. So it's a great concept. And then all the things we know, but I don't really want to talk about the infinite banking space because there's a lot of infinite banking people out there that I don't know if they're doing it the right way. And I remember a decade plus ago when I was training in the industry, there was a lot of infinite bankers that were doing things, in my opinion, really wrong.
I agree.
And so it's hard for me to comment on that. So I'll just go back to what we do in our practice. So if I have a contractor that is building a huge vat of cash, and it's either or, actually, black and white, I'd rather the cash value whole life from a quality dividend, a mutual dividend company, is going to be the ideal tank to use. However, the variability in funding usually is better than an IUL brings, and we can use that early cash because a lot of times their income is very, very in flux, or they hit a really bad time, right? And so having some of that flexibility. In fact, one we did both. We show the client both options, and we give the client the complete transparency. Here's the risk of IUL. What do you want? One said, how about I do 50-50? So that's a great idea. We did both.
Sure.
So it depends. But if it's a black and white thing, I think cash value whole life funded properly is going to be better for a banking type concept in most cases. I'll say this for the not sophisticated client that IBC is being used. I'm not sure it's right. But in that case, I think IUL is a much more dangerous stick of dynamite for those types of cases and those clients than whole life is.
This is a follow-up question, and then I'll get to you, Chris.
I actually have a couple questions.
Okay, so my follow-up question to that is, when in the way that you illustrate, not the way that other people illustrate, when does IUL outperform whole life in the cash value? The reason I'm asking this is it sounds like income is the play that that IUL fits. And it's interesting because I went through the same demutual process, and the conclusion that I came up is I'm not going to sell life insurance for future income. I'm gonna literally look at the first 10 years and then we'll go on from there. But I'm not going to sell something for 30, 40 years from now, because I realized like how naive I was and how everything can change.
Yeah.
And so for me, going back to what Chris said, is like, I want something that is structured in a way that if 2 years, 3 years from now, 40 years from now, I could cash out, I could transfer, I have flexibility in funding, which there's flexibility, but like show me the money. Don't show me what 30 years from now could look like if I fund this thing properly.
Yeah, so I think that running an illustration that shows like an income stream from 65 to 85 is dangerous.
Yeah.
Okay. We run it for our own testing purposes, or but we look at it as a buffer strategy, which for those of you that don't know what that means, if there's a down year in the market, you don't really want to be pulling money out of your stock account because you're selling out at significant loss that won't recover. So you can use something like a life insurance contract to supplement that income for a couple of years until the stocks recover. However, we also look at it as a buffer strategy for taxes and tax brackets. So we don't have the time to get into that, but I want to minimize the tax liability for my client. Mm-hmm. And so between 65 and life expectancy, there could be a lot of variability in income. And so the life insurance can be a great tool to help mitigate taxes on the income through a bucket approach. Did I answer your question?
No, so yeah.
I'm sorry.
When does the overlap in your illustrations, like when do these life IULs break even? That would be
versus whole life.
Yeah, versus whole life.
You mean crossover point?
Yeah, crossover point.
Versus whole life.
Year 5 to year 7.
So depending on that's pretty competitive to whole life liquidity. What is in the first year or two? How much liquidity is your clients getting if they wanted to surrender their policy?
So that depends on if that. So if we're building it for income, right? We don't want the early cash access rider, right? So we want the full
Right.
index.
Yep.
So you have surrender value and actual cash value. So the cash value is what's getting credited on, but the client
Yeah.
can't take that money.
Right now, I just care about surrender value.
Yeah. So it's very similar to a whole life contract. It's less. It's going to be less than whole life. I mean, whole life's going to be better in that scenario. Usually, it depends.
Yeah.
Depends on how you.
But are we talking
whole life
50-50?
policy.
Are we talking like?
It varies.
Okay.
It really does vary.
And the
In
reason I asked that,
the first year.
yeah, the reason I asked that is like if everything hits the fan, it's like what is the 1035able? What's mine that I could cash out or transfer?
Only the surrender.
Yeah,
value.
that's why I asked.
Right.
Yeah.
And I will say that if you turn off the enhanced cash value rider, right, IUL is better than most whole life. Although there's some whole life companies out there that have created some new products, I can't mention the name, high early cash value that actually are pretty darn close.
Yeah.
So I think.
Yeah, I know you have got.
Well, no, I mean, there's a couple things that I just keep kind of ruminating in my head. It all comes down for me. I always speak to what are our values, what are our beliefs. I think people fail with their money because their money's not in alignment with their values and beliefs. They don't even know what that means and haven't spent enough time contemplating what they're actually trying to accomplish first. So I'm not saying that's you and your clients, but I'm just saying in general. I've been doing a lot of like deep dive research for myself on, once again, my values, my beliefs, and where I think the economy is going, what I think is going to happen. And I think no matter what, there's always risk, right? The risk of taking a more conservative approach is that you lose some upside, and there's an opportunity cost to a conservative approach. The risk to taking too much risk and doing a more risky strategy is that you have the potential of upside, but then if it goes the other direction, you lose, right? And so and this is why I'm so hard on the IUL challenge. And when we talk about, oh, well, you can't do a whole life challenge. Well, whole life isn't sold on upside potential. They didn't provide the upside in the greatest bull run of all time. So where's the upside potential? I wouldn't have a problem with the fact that they underperformed if that's not how they were sold every single day on every single TikTok and Instagram video that I've ever seen. So that's that. But that's not even my point. So moving forward, and this is a question for you. This is something I've been contemplating a lot. I made the bold statement yesterday, and I saw you in the back of the room kind of like shaking your head or laughing or, is that whole life is going to outperform IUL over the next decade. And the reason I think this, and I'll just make my case and then I want to have you respond. The reason I think this is because I believe that we have no choice but to be in a bit of an elevated interest rate environment compared to where we've been. I believe that rates actually will wind up going up even higher than they are right now. They stay where they are, they go a little higher. If they come down at all, I think it's going to be for a short period of time. That is what it is. Now, my belief on this is I could be wrong, right? But I like, and Caleb and I have gone through this in the past, is like, what's the upside? What's the downside? Can I live with the downside? And
good question.
And so when I look at this and I see what I believe to be true, even though I fully know I could be wrong, right? We just have to think what I believe to be true. Do you think interest rates are going to go up or down or stay the same? It's one of three things. It's got to be one of three.
Yeah.
Up, down, stay the same.
Yeah.
What do you, question?
I have no idea.
No idea.
I think anyone that tries to predict what interest rates are going to do is fooling themselves.
Okay, that's fair.
It's a very
full of myself.
Gray. It's a very gray road ahead.
It is. No, it's totally gray road. And so but I think it's important as advisors to be considering the direction things are going to go.
Right, I agree.
Right?
Yeah.
And making decisions accordingly, and also making sure whatever decision we make, if we're wrong, we're still okay.
So,
is that fair?
So here's the answer about whole life versus IUL. Going back to 2008, and really a lot happened in 08. Could do a whole podcast on that. The world lost 80 years of GDPs, never come back. But you have to realize that with an insurance company like a mutual whole life insurance company, it's one block. You can't open and close a block, right? Everyone's sharing in the same pool. Mm-hmm. And so you have decades of this massive account we call the general account. That's the big cash reserve all insurance companies have. And that basically is an institutional bond portfolio. And like any institutional bond portfolio, they're going to have short, mid, and long-term
Sure.
blocks of business in there. And so you go from a period of the 50s, 60s, 70s, right, where you had interest rates, let's say you have a block paying 7%, 6%, 5%, 8%. And when the great financial crisis happened, and even before that interest rates come down, when those blocks come to maturity, they have to buy into the yields of the current time. And for a few years, you can kind of mitigate that, but no one expected rates
to be so low,
be under inflation, which that's a whole nother story, because that tells us that the government's manipulating things, because that's not normal. It's not a normal functioning economy. For 10 years plus. So for 10 years, every company out there, I believe there's going to be more mutuals that are going to fail. I believe you have to be with the big four or one that's like the big four, because they all have to figure this out. And I've been at the home office and saying, how are you guys mitigating this? And most don't even know what I'm talking about. Some do, because you've taken we're talking billions of dollars of capital that they had to reinvest at lower yields on products that they assumed were higher yields. It's going to take a long time to recover. Then you take COVID and rates spiked, which means they just had a huge capital loss in a lot of that account. So now rates are going up. I do believe mutual whole life is going to start doing better, but it's going to take 20 years. I think in the next 10 years, it's going to be a difficult road. And I actually do believe index universal life will outperform whole life in the next 10 years. And Bobby Samuelson would agree. In fact, he did a whole study on this and showed this. Because of that lag. It's a lag.
It's a lag, yeah.
The general account.
The dividend rates are going to chase
now,
typical.
What's helping that actually, and one of the reasons dividends have gotten better is because mortality is lower than they expected because people are living longer. That's actually helped that a little bit.
Sure.
From the original assumptions going back 30, 40 years ago.
But one of the things that happens, like, and Tom Wall actually told me this for the first time, he goes, if zero is the hero, then the cap is the trap. And so the cap, at 10% being the most you can make, if you have a couple down years in a row, you need a lot of cap years to get back to the average that you're looking for, you know? And so that's where he's saying the cap is the trap. And like, so when
can I comment on that?
Sure. Go ahead.
So again, the agents that sell this stuff and forget about it, and I see a lot of IUL policies. I'm like, holy crap, your agent hasn't talked to you in 10 years. It's really scary. That's true. But remember, if we're managing, our firm, we're managing this. We meet our clients at least once a year, usually quarterly. We're talking to them all the time. I manage my own portfolio models for many years now. We're the firm where we have an RIA we trust. So I'm very active. And so obviously if it's a world where the market's going to tank, we're going to move it to the guaranteed.
To the fixed account.
Sure. which is getting the 4%. Okay. We tested this back to the Great Depression, right? And so we've kind of looked at those 0 years, and still, I'm not going to say on camera what the rate is. I'll tell you this behind the scenes. I'll show you the research. I feel very confident that in the next 10 years, we're going to be okay. But I also know that if that like worst part of the world, that end of the world scenario happens, we can always move it to the fixed account.
I had an interesting interview, and this is, neither here nor there, but like an interesting interview with a guy named John Wolfenbarger, and he runs bullandbearprofits.com. And he was going through all his statistics and just research. And he shared with me that Warren Buffett's favorite metric of valuation of companies and when he invests in different things, but it's how he makes his decisions. This one thing, it's like literally the one thing. And I went after the fact and researched it. I can send you what I found, but this statistic, this one metric is saying that the market is going to be worth 50% what it is today, 12 years from now, which is a crazy, crazy, bold, insane statement. I almost didn't believe him, but I went on to the Fred stats and all this stuff, and it's true. If he's not right, even if it's the same as it is today, 12 years from now, IUL's screwed.
What do you mean? So he's saying that it's 12...
that the market is so overvalued right now because of the fact that the price to earnings ratios, PE ratios right now are the highest they've been since 1929.
But as we continue to print money, do you really think that that will cut in half in the future?
I'm just saying at some point in time, something has to give. We're either going to have an inflation problem or we're going to have a deflation problem. We're going to have a financial crisis. One of the two is going to happen.
And you're saying when that happens, people are going to liquidate their
And so what
equities.
I'm saying is having whole life over the next 10 years, and the reason I bring this up is because having whole life where it's this slow, good, dependable growth curve, whatever, is even more valuable, right? Whereas IUL, if it's associated with an index and the market volatility is all over the place, and furthermore, if interest rates keep going up, I'm partnering with the company that's managing this bond portfolio equivalent, right? And so I'm letting them manage that risk. I'm letting them get me that return. That's what I'm doing. If I give them my money in an IUL, all that is doing is controlling the bond or the options budget, right? And so there's two variables there, right? So if they have the options budget and their options budget increases, well, typically speaking, all this market volatility that happens increases bond costs. This happened several times over the last decade. This is one of the reasons that in the greatest bull run of all time, IULs performed worse, is because these things, it's not just because the options budget went down, it's because options costs also went up. And I mean, if you look at Bobby Samuelson's, index ranking, this is a thing. The cost of a 10% cap.
So you bring up good points. We could have many other podcasts going into.
Let's do a series.
Yeah, we should do that, right? Especially talking about the next 10 years, what could happen. So when you say the market, I mean, how are we measuring the market? I mean, the S&P 500, which is a fraction of the number of public companies you can buy out there. 7 companies bring in 30% of the returns. If you take out those 7, the S&P's done about 3% over the last 4 years.
That's pretty gross,
right? So, but the P&E of small and mid cap, not even in the index, is actually small cap. I can't really talk about investments because I am licensed and I have to get approval for that. But the market is 13,000 securities, and so when most people go on record talking about the market, they're talking about the S&P, which to me is a small. And I do agree that there's going to be a huge. I believe, and hopefully I'm not breaking any rules here as a licensed person, but I believe there's going to be a day of reckoning in a lot of that. I do agree. Let's go back to the IUL and the risk in that. Okay, so we're with an IUL. We use IUL that's with a mutual company. That fixed account actually went up the last year. Like because the whole life did.
Sure.
That fixed account is directly benefiting from the general account, just like their whole life sister company and the others. And so, let's say that happens, we can move the cash in the IUL to the fixed account. But something we can do in the IUL that we can't do in whole life, in a world like that, let's say we have a world that just everything tumbles down, right? Mm-hmm. So with whole life, the only way for a client, like a business owner that may have cash flow issues, is we have to let the contract APL, right? If they can't pay the premium.
Mm-hmm. Automatic premium loan.
Automatic premium loan if you can't pay the premium. Hopefully that all works out. Where IUL, and by the way, for the agents out there, we never tell our client what the minimal premium is. If the client wants to start an IUL with the minimal and hopefully pay more in, that's a big problem in our industry.
Yeah.
Every IUL should be max funded. If the client can't afford it, then don't sell them the contract or lower the death benefit, but don't sell them minimal. We don't even let our clients know what the minimal is because we don't want them to get in trouble. But at least if in a world like that, we can say, hey, all you got to do is put this in the contract and you'll be fine, or let the earnings on the contract.
I get all that, but once again, this goes back to what you were saying before that we talked about, is like your active management is the absolute key to this. If you're not managing this on literally a quarterly basis, which most people can't be successful meeting once a year, because if they're meeting every client they have quarterly, when are they going to have time to actually go out and sell and prospect and help and like all these things?
And to be fair, actually, the AUM side is much more active. The IUL is, you don't have to manage it quarterly. I mean, it's an annual cycle, right? So it's really not a big deal. It's easier than managing.
Well, that once again, that comes down to the company. That comes down to the company because a lot of them have monthly.
That's getting into smoke and mirrors of some.
Is there anything else you guys want to bring up before we wrap up? Because I know that there for sure could be part 2.
Sure.
I mean, there's a lot more questions that I have, but I definitely think we'll definitely have more conversations like this. I'll just say, if you're watching this and you're like, Terry's wrong, Chris is wrong, Caleb's wrong, comment, share, and we want more conversations. That's one thing I'm committed to, is more conversations versus less. And so we want to hear from you. And if you want to come on and have a conversation, let us know, and we will make that happen. Any final words that you guys have as it relates to this?
I'll just say, you invited me here to talk about this, and it's not. I talk a lot, and this I don't ever talk about this. So,
welcome to the world of YouTube.
I didn't want this to be IUL versus whole life.
Yeah, and I don't think it was.
No, I don't think it was.
Yeah, it's IUL. It's whole life and IUL, depending on the case, right? So it's looking objectively in what's best.
We'll put that as a title with Chris's face. With his like this. Whole life and IUL. Just it's an and.
No.
Talking to the microphone.
Yeah. I could just respectfully disagree. I will say, out of all the IUL agents I've ever talked to, I have more respect for you than any of them because of the way you do it, because of the way you're managing it, whatever. I just really think it comes down to the fact that the nature in which basically what you're saying is the life insurance company has given me this chassis that I can play with as a manager of it, as the advisor of it. And you think you're going to manage that better than the general fund managers of the multi-billion-dollar company. That's what you're saying. That's effectively what it is.
No.
Because otherwise, the whole life long term, I was talking to Tom Wall.
What is there to manage, though? What is there to manage?
Well, what index do you want to participate in? Are you going to shift it to
index.
Is it the S&P 500?
Yeah.
Okay.
12-month point to point. In my opinion, all the other ones are smoke and mirror.
No,
games.
they are. We agree on that.
So it's that, and if as an investment firm, if we see the economy where the market may be really down the next couple of years, we might move it into the fixed account. It's easier than managing a bond portfolio. I mean, to that argument, why would I have an investment firm as well? Well, maybe I wouldn't, but this is where we've been called to help and to serve. So it's kind of baked into what we do as a firm.
So at the end of the day, I think for me, it just comes down to, though, is like, I don't want to ever take risk in a life insurance contract. And it is a life insurance contract, not a policy. It's a contract. And contractually in a whole life policy, all the risk is on the insurance company to meet the obligations for me, the policy holder. When I put money into an IUL, the risk is then shifted to the policy holder from the insurance company, fundamentally speaking.
We can agree to disagree on that.
There's all these moving parts. There's all these moving parts inside of the policy. And I don't think insurance companies will shift those parts because they have to, or because they want to. I think they'll do it because they have to, based on the different economic things that are happening. And when push comes to shove, if they have guarantees they have to meet for their mutual policyholders in the whole life policies, and then they look at the IUL and they go, the push comes to shove. It's been proven with a lot of this, the way that they handled UL policies. And granted, there's other factors that play that, with lowering interest rate environments and all these things that came into that. But I'm a big believer that when somebody tells you who they are, you got to believe them. And there's a history of bad track records with universal life chassis products. And they've tried to do a lot of different things to make them look good. And don't get me wrong, we've sold a couple IULs and we're selling some IULs now, but they're not. I know. Caleb's like, what? Caleb's like, what?
That's going in the hook.
Right? So, but here's the deal. It's never for income, never for cash value, always for the guaranteed death benefit rider. So it's like a legacy play that says it's basically like a GUL, but on a little bit more of a flexible chassis, with you being able to say, we're going to guarantee it until 96 years old or 105 years old or whatever it is. And it's a perma-term play is really what it is. And that, to me, is the benefit of IUL, like having the ability to do that. Outside of that, utilizing it for any kind of tax-free income. Let me ask you this. This is one question I didn't ask, and I'm sorry, when you do loans in retirement for the buffer strategy or for income, whether it's a stream or whatever, are you using the indexed or fixed loans?
We can use both depending on the environment, but generally I would use the index loan based on the research we've done.
Okay. So you're not at all concerned with the fact that loan compounds against you, and then on down years, that adds a lot of expense and cost to the policy.
Again, we can change the loan, and we can get a guaranteed wash loan if we need to, which is fixed and zero. It's a wash. In the current environment and the research we've done, this is a deeper subject.
Sure.
But with the research we've done, we have confidence in using the index loan strategy.
But you would also agree, I feel like an attorney. You would also agree that
because here's the reality: a whole life company, A whole life company can do the same thing. If we're in an environment where that's a risk, there's a 100%. The whole life company doesn't have to pay the dividend.
But that's not what I'm talking about. That's not the risk.
You said that.
No,
you said
no,
it's
no,
a
no,
contract. Whole life is contractually guaranteed, implying
that's not the
IUL is
point.
not contractually guaranteed. It is a contract.
Sure.
There are guaranteed levers, max and min. Most agents don't know how to read that in an IUL contract. I know what the guaranteed max and min, where they can pull that lever. Whole life has those same levers that the company can pull. A whole life company doesn't have to pay the dividend.
But that's not the conversation. The conversation is saying if you had $1 million outstanding loans and you have a 5% index loan, that's a cost that's going to be there. And if you don't at least earn 5% in that policy to break even and earn the equivalent loan credits, that's going to be an additional cost and fee inside of that policy.
Of course it is. The same is true with whole life.
Yeah, but the difference with whole life is it's very flat and it's very measurable. With IUL, if a 0% year adds 5%
the fixed
charges.
account is not a 0%.
Yeah, but you're not going fixed. You don't get to choose fixed after the year market does 0 for the year. You don't get to swap it post-active.
So here's a real story. We have a client with $4 million in loans out between two mutual whole life companies. And the one whole life company, which is one of the top 5, actually, he is paying 4% because it's an old contract, and the mutual company could have done the right thing, but they didn't because it's an older contract design, right? Where if it was an IUL contract, I can guarantee it's a 0 wash.
If you do it ahead of time.
But I'm saying it's either or.
But if you do that in an IUL, what you do, if you do that in an IUL and you choose a wash loan, you're not eating into the net amount at risk. And so the annual renewable term is going to remain higher, which means every year your annual cost of insurance is going to go up.
No, because we can control that.
If you're like, would you agree that
by the time the contract
we're finally getting heated for you.
By the time the contract goes into where there's going to be loans, we've controlled those costs.
But so would you agree?
Which I can't do in a whole life contract. Remember, I can't do that in a whole life contract.
Would you agree then that your level of management and the complexity of your management goes infinitely through the roof?
It's not that complex.
When it gets to
retirement. It's not that complex. Actually, it's one phone call and 5 minutes to set it, and it's done, and never have to worry about it again.
Yeah, but if you...
So here's the example. Whole life contract, I have $1 million cash value. I have to have it reduced, this is hypothetical, pretty close, $2 million net amount at risk.
Sure.
Client takes a loan on a whole life contract. There's $1 million of cost of insurance coming out of that contract, and the company can pull that lever to reduce dividend. Or with an IUL contract, I have about a $300,000 net amount at risk. I can bring it down from $2 million down to about 1.3. That's far less risky. If $1 million loan is out, it's a very small amount at risk where that cost is coming out. Where whole life, that's a much higher cost.
Yeah, but that's not fair because
it is.
No, it's absolutely not, because with whole life, the cost of the insurance is more leveled off throughout the policy. So the risk when you get later, because you've more paid earlier, and it is more expensive earlier.
That's not fair.
It is absolutely fair.
Mortality
is mortality. And so if there's a mortality cost for the policy... No, hold on. No. Let me finish my thought. If there's a mortality cost, let's say we do $1 million of insurance with whole life and $1 million of insurance with an IUL. Fair enough? The mortality cost throughout the lifetime expectancy of me or you is going to be, whatever it is, say $10,000, $100,000. I don't care what the number is. If the mortality cost is a mortality cost on those policies, over the lifetime of the policy, they're going to be what they're going to be. With whole life, those fees are paid earlier. Absolutely. With IUL, what's the annual renewable term? If you have $300,000 of net amount at risk in an IUL at 85 years old and $300,000 of net amount at risk in a whole life, the cost of the IUL are higher.
No.
Yes.
No.
Yes.
Okay. You can't know the answer to this. This is not a setup. What's the cost per thousand for a 65-year-old? What is it for a 75-year-old?
It just depends on the company.
Right, but the number's on a rate sheet somewhere.
Sure.
The company,
but it changes per product.
Whoa.
It changes per product, and it does change per product.
If mortality wasn't mortality, then every life insurance company would be out of business.
Good stuff.
Every life insurance company. Let me finish. Every life insurance company would be out of business. The cost per thousand for a 75, 85, 90-year-old or 35-year-old is fixed based on the underwriting and the experience of that company.
Sure.
That cost is amortized into a whole life contract throughout the life of the contract, and it is with an IUL contract as well.
So you're telling me that companies don't change the cost per 1,000 based on different products at all, ever?
Well, of course they do.
Okay, so
Of course they do.
Cost per 1,000.
But your implication is that
that's
IUL
not,
could spike later in life.
No, I'm saying that
and whole life wouldn't.
I'm saying that the cost per 1,000 of annual renewable term at 85 years old is more than the cost per 1,000.
See, that used to be my argument, but it's not.
It is absolutely the case.
It's not exactly the same as annual renewable term, because annual renewable term does not have cash value to offset that net. It does not reduce that net amount at risk. It just keeps going up.
The cash value has nothing to do with it. The cash value.
Wait.
The cash value.
Are you telling me if I have $1 million term policy with no cash value at 65,
but that's not the net amount at risk.
Versus 800,000 in cash value, there's no difference?
If you have a $1.5 million death benefit and $1 million in cash, the net amount at risk is the $500,000. That's the number that is the annual renewable term cost. That effectively, that is where the charge comes in.
Of course.
That's the risk.
But that cost is whatever that cost is for that company.
Right, based on the annual renewable term schedule of their age.
Right, and it's the same for whole life.
No.
Sure it is.
No.
It has to be, or the insurance company's got to business. If the insurance company didn't price the whole life contract accordingly,
they do, but
bankrupt.
They charge more upfront. That is the point. It's going to be more expensive earlier. That's why IULs can do what they do, because their annual renewable term is cheaper earlier.
Why is a whole life insurance contract cheaper earlier? Why?
What do you mean, why is it cheaper earlier? It's
why
not
is there lower?
earlier.
Why is there lower?
There's just no surrender charges.
Wait. Why? I misspoke. Let me recant that. Why do you think a whole life insurance contract, right, has more expense early and less later? Why?
Risk.
Explain that.
The insurance company, like
the net amount at risk.
Sure. And so the insurance company is having you cover those charges and cover those expenses. And they're leveling out. They're saying our mortality expense for this policy throughout the lifetime of the policy is going to be X. And so we're going to have you cover the fees, and it's going to be a more level expense, more on the mortality expenses, whereas the mortality expenses are lower. If we went over a 50-year period in both, let's just say in a vacuum, they're both the same. IUL is going to be cheaper earlier than whole life, and it's going to be more expensive later. By the time we get to year 50, let's say we had the total same mortality charges out of both. But the difference is, this is where I have a huge problem with IUL, is because of the fact that when we get to retirement, I don't care what the policy does for me right now. If I need it to be dependable for me later in life, which is what we're talking about, I want the costs and the variables to be controlled. Control is one of the most important things. In the IUL, that variable of control is something that you don't have, period.
So
you don't.
So actually, we do have that control with the IUL. You don't with whole life. The company does.
You're going to try to tell me you could shrink the core.
Hold on. No, wait. Let's go back to this. So a whole life. Here's the difference. You're not being fair with IUL, because IUL has you're assuming it's minimally funded.
No,
so yeah, okay.
So
would you agree that a whole life premium for $1 million on a 45-year-old, the premium required for that contract is much more expensive than the minimal premium on an IUL contract?
Of course.
Okay. So for the listeners out there, what I'm saying is let's say hypothetically a whole life contract, the premium is $20,000. For an IUL contract, same death benefit, same person, they can put $20,000 into it, or they could put maybe $6,000, the minimal. Right? So if we're funding it at $6,000,
well, you're also assuming that I'm just running a base, 100% base whole life, which never happens.
Well, actually, it doesn't matter.
100% matters.
Let's say
you're assuming.
Well, then let's say it's a paid up of 65, which is already designed to be paid up.
But I would still not do 100%.
Hey guys, so we had some technical difficulties there at the end. I'm not sure how much of the interview you're going to see. We were about to land the plane. We were all like kumbaya, and then something you said, shocker, the crazy eyes came out. and there was probably like a 10-minute at each other's throats going back and forth. And I was like, this is amazing. I can't wait to use this for a hook. You literally said, like, Chris, you were like, I'm a fan of IULs, or I've used the IULs. I'm like, that's going in the hook. And you're like, and all these things were, and then I looked over the camera and it was dark. And so we must have ran out of memory. So here's what I'm going to say is, we're obviously going to get version 1, no matter what this looks like. And then all of us are committed to either doing something virtually or another conversation in person. So I just want to thank you. Please subscribe to our show. And also, like, if you have thoughts, comments, if you have points, please put those in the comments. We're going to read all of them. And in part 2, we're going to bring those to our conversation. Thank you.